What's up guys, welcome back to InvestingPH. So today we will evaluate International Container Terminal Services Incorporated or ICT. Its price right now has really gone up, already higher compared to its pre-pandemic price. So is it still worth buying right now? Well, that's what we will try to find out in this video. So let's start. So an endless reminder to you guys that you should still be doing your own analysis whenever you invest in a certain company. Don't use this video as basis for your investing decision. So if you like the company after watching this video, then do further analysis of it. And as always, I would really appreciate it if you hit the like button for the YouTube algorithm. And of course, if you still aren't subscribed, might as well hit the subscribe button as well. Let's start off by knowing the company. So who is International Container Terminal Services Incorporated? ICT was established in December 1987 in the Philippines. It has become a leading operator, innovator, and pioneer in its field. The group operates principally in one industry segment, which is cargo handling and related services. The company's shares is owned mostly by Enrique Razon, at which has 61.43% shares, 38.28% is owned by the public, and 0.29% is owned by their directors and officers. Right now, the company has 34 terminals that spans from 20 countries across the globe. This can be divided into three. First, Asia Pacific, at which has a total contribution in terms of volume by 51.9%, which has the largest share. Now, their volume dropped by 2% from 2019 to 2020, but their revenue still increased. Next, their terminal in America. This has 30.3% contribution in their overall volume. This both revenue and volume increased in 2020. Lastly, Europe, the Middle East, and Africa, at which has 17.7% contribution in their overall volume. Their volume increased slightly, but their revenue decreased by 1.4%. With that, this is their total volume and their revenue from 2018 up to 2020. We can see the volume that they can accommodate is increasing as the years goes by. With that, the revenue follows as well. And we can see the effect of the pandemic. Their volume only grew by 0.2% in 2020. Their yield per TEU has increased from 146 in 2019 up to 148 in 2020, which was only a 1% change. But again, this is only their revenue. So later we will find out in their financials how they are producing net profits from this and how they were really affected by the pandemic. Now, since their business is situated in different countries, the company is also affected by the ups and downs of the different currencies. With that, these are the breakdown of the revenue and its different currency. The largest percentage is in the USA and second is in the Philippines. So this is one thing to take note on, that price changes in currency can affect as well their revenue. Now, since this company's revenue greatly depends on the volume of containers they can accommodate, of course, we have to take in mind how well they are maintaining and expanding their terminals. So for their capital expenditure, in 2020, we can see mostly they are using it for expanding their business and maintenance. This was in Manila, Mexico, Ecuador, and Congo. And they also have a new project in Rio. So for their 2021 capex, 77% of it will go to expansionary, which is in Manila, Congo, and Australia. So with this, we can see the business is devoting more in the expansionary side, at which can help the company grow more in the future. The more volume for them, the more the revenue may grow. With that, let's go to their financials. We would still be following my checklist in evaluating this company. So if you want to understand more each line of it, I suggest you watch my other stock analysis as well. First, let's look at their income statement. Now, their financial statements is shown in the dollar currency. We've seen a while ago, number of volume of container greatly affects their revenue, at which we can see even amidst the pandemic, their volume of containers slightly increased. With that knowledge, let's dive in. Let's look at the revenue first. We can see since 2010, they had been growing their revenue consistently. They only had 1 year of negative growth, which was in 2015, but only a slight negative. Now, like we've seen a while ago, their total volume increased by only 0.2% from 2019 to 2020. That's why we can see the revenue only grew by a small margin. So not bad for the pandemic year, still a positive growth. Their compounded growth rate from 2010 to 2020 is still standing at 12.08%, and for their latest 12 months, they have already grown by about 10.52%. For their net income, this tells us a different story. In 2019, they had a massive negative 51.62%. Now, this is mainly because of their one-off non-cash impairment for the assets of TechPlata, which was revalued. So if not for this one, their net income would have had a positive growth in 2019. Anyway, it's still a negative growth for them. This is again the same story in 2020. Because of their impairment charges and non-recurring items, their net income would have had a 9% increase, so plus the slow growth caused by the pandemic, but on the brighter side, their latest 12-month had already a massive increase, which had grown by 81.85%. But remember, this only brings them slightly back on track in their pre-pandemic numbers. It is still less than their 2018 mark. Their compounded average since 2010 is sitting at 7.28%. For their net income margin, their average percentage is at the 14% level in the span of 10 years. Now, this pandemic, it really dropped down. Still, this is a check since they had a positive growth in the 10-year period with an annualized growth of 7.28%. Now, I'm really emphasizing their income statement since this will greatly affect our assessment later on if this company is undervalued or not. We can see even though they had massive growth in their latest 12-month, this is still short for their pre-pandemic numbers. Anyway, moving on to their equity. Now, if we first look at their total assets, we can see it is really increasing along the years. No negative growth for them. And looking at their total liabilities, they had a drastic growth starting in 2017 and of course, this pandemic years. This affects their overall growth in equity, at which we can see here. They still haven't recovered past their 2015 equity. And well, this pandemic at which a lot of companies had acquired more debt, but even with that, their total annualized growth in 10 years is still standing at 11.44%, which is good. But this is one thing to take note on, that their current equity is still below their 2015 period. Now for their ROE, they have a 5-year ROE average of 8.1%, which is not bad for a large company. Now this tells us how well the company is using equity in producing net profits. But since I don't have anything to compare them with, the closest business to them is Asian Terminals, at which has an ROE above 15%. But it's relatively small compared to them. Now ICT is one of the largest in the world when it comes to container terminals. So since I don't have a comparison, I would be using my minimum standard for my ROE valuation. At least I want to look for is an ROE above 10%. So they fall short on my valuation here. Next, let's see if they aren't relying on too much debt to grow their ROE. Now, like what was mentioned a while ago, we've seen how they stacked up more liabilities at which led to the drop in their total equity. So right now, their total debt to equity is at 2.63, at which is higher compared to what I want, since what I look for here is for this ratio to be less than 2. Moving on to their cash flow statements, so their cash from operations is increasing every year. And with their capital expenditures going down in some years, we can see their free cash flow is in a steady growth. Their 10-year annualized FCF growth is at 15.99%, which is high. So this one, it's a check for me. Now let's see how well they are handling their long-term debt. So if they use their FCF to pay up their long-term debt, they only need 2.49 years to pay it up. So another check, since what I want here is for FCF to long-term debt ratio to be at least below 3. Moving on to their current ratio, so this tells us how well the company is handling their short-term obligations well or their short-term debt. With this, they have a current ratio of 1.52, meaning they have 1.52 peso of current assets for every 1 peso of current liabilities. Another check, since what I want here is for this ratio to be at least above 1. Next up, their PE ratio. So right now, they have a price-to-earnings ratio of 62.08, which is really high. So you are paying 62.08 peso to earn 1 peso. Now, even if we use their highest EPS, which was in 2018 pre-pandemic, their PE ratio would still be around 54, which is still so high. Now, I want to show you another price valuation, which is the price-to-book ratio. Right now, they have a price-to-book of 4.53. So you are buying the company 4 times worth of their assets. So 2 price valuation is telling us that this company is overvalued already. Now, let's go back to the PE ratio. Imagine this one. The company is only growing their net earnings at a rate of 7.28%. To catch up to this massive PE ratio, the company needs to grow a lot in the following years, more than 20% annualized earnings growth per year, consistently in the next 10 years to meet this high of a valuation for them. So this is definitely an X for me. Now for the company's dividends, they regularly pay out dividends. Now since their stock price is also high, their dividend yield for the current price would also be lower. Right now, based on 2020's dividends, their dividend yield for the current price is at 1.75%. Next, for the company's moat, what makes this company sturdy? Now, ICT is one of the largest container terminal in the world, so it's not just leading in our country alone. Dominance in their field is a great competitive advantage, and we can see they are still adding more terminals in different countries. So in our country, none can match them in their field. Now, for the company's leader, their chairman and president is Enrique Razon, the second richest man in our country. Now, with how the company has grown to be one of the largest container terminal in the world, that alone provides us a glimpse of his leadership. Besides being the founder, he still holds a lot of stake in the company. This, I think, he won't let his company fall down, and his family had been around this business for generations. So for their leadership, this is definitely a check. Moving on, is this company within my buy below price? My computed intrinsic value for them is 184.55. Having a 30% margin of safety, my buy below price is at 129.18, really far from the price right now, which is 189 during the time of this recording. Now, looking at the PE ratio alone tells us how this stock is valued right now. It's trading at 64 times its earnings. Although yes, you can say their latest 12 months net income grew by 81%, but remember, their net income fell down in 2019. Even though it has grown that big, they are still far from their 2018 earnings. That's why it's good to look at a much bigger horizon. Don't just look at 1 year's worth of growth because it doesn't tell you anything. You may be fooled by the large earnings increase, but if you compare to their previous years, they are still lagging behind their past earnings. Anyway, with that, this concludes my analysis for this company. Now, although this is a good company, dominant in their field, still I want to pay a good price for them because whenever you invest in a stock that is priced so high, you have to be sure that the company will grow at a higher rate to be able to catch up to its price. Your margin of safety becomes so small and your risk becomes higher. So for me, I'll just wait for it to reach my comfortable price. If I'm wrong, then that's okay. There are still other stocks for me to invest in. You can't predict them all. With that, if you liked the video so far and still haven't clicked that like button, I would really appreciate it if you would do so. And again, if you still aren't subscribed yet, might as well click the subscribe button as well. So thank you and see you in the next video.